Let's start with the first trading model. This strategy is made up of three main concepts: a draw on liquidity, liquidity grab, and entry. In this setup, we use two time frames to enter the trade. On the higher time frame, we mark the key liquidity levels and find a draw on liquidity. Then we zoom into the lower time frame. On the lower time frame, we want to find a liquidity grab in the direction of the draw on liquidity. Then we simply open the trade and set our target and stop loss. Before we get onto the charts, remember, this trading plan is not limited to any specific time frame. However, your entry time frame must be 2 time frames lower than your higher time frame. Here are 3 time frame combinations you can use based on your trading style. For example, if your higher time frame is the 4-hour chart, you should zoom into the 15-minute chart to place the trade. Now let me show you how it works on the price chart. The first step is to find a draw on liquidity on the higher time frame. But what is a draw on liquidity? It basically means identifying a key liquidity level that price is moving toward. In simple terms, the market often moves to areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many stop losses and pending orders are waiting to be triggered. You can mark these levels manually. First step is to look for a key high or low on the 1-hour chart that price is moving toward. So let's enable the key liquidity levels in the indicator settings by turning on equal highs and lows and buy-side and sell-side liquidity. As you can see in this example, we have buy-side liquidity on the 1-hour chart, and the price is drawing up toward it. We can anticipate the price reaching for this high, since that's where liquidity exists. If you can't find a clear draw on liquidity on your selected time frame, you can analyze other time frames to find a clearer formation. The next step is to zoom into a lower time frame and identifying a liquidity grab in the direction of our draw on liquidity. So, let's switch to the lower time frame. Keep in mind that the buy-side liquidity is above us. Now we're looking for a swing low to be taken out. In other words, we want to find a bullish liquidity grab, which signals potential upward continuation. When you enable the liquidity grab option in the indicator settings, you'll notice that the red and green circles appearing on the chart. These represent bearish and bullish liquidity grabs, respectively. A bearish liquidity grab occurs when price breaks above a previous high, but quickly moves back inside the range. This shows that buyers failed to create a new high, and price is immediately pushed back into the range, indicating bearish momentum. And after such a move, we often expect a stronger move to the downside. Similarly, a bullish liquidity grab occurs when price breaks below a previous low, but quickly returns back inside the range. This indicates that sellers failed to push price lower, and the market immediately rejects the lower prices, signaling bullish momentum. After identifying a bullish liquidity grab, we can enter the trade right after the price returns inside the range. Alternatively, a more conservative approach is to wait for the price to continue pushing upward to confirm the reversal, and then look for fair value gap formations to set a buy limit. If you can't find any FVGs on the 5-minute chart, you can zoom into the 1-minute chart for more precision. Now, let's have a quick recap for the bearish setup. In a bearish setup, first find an important liquidity area that the price is moving toward. This could be a previous low or a level where many stop losses are sitting. These areas often attract the price before it reverses. After that, switch to the 5-minute chart. Wait for the price to move above a recent swing high and then quickly come back down. This shows that the market has grabbed the liquidity and may start moving lower. Next, open a short trade and place your stop loss above the high of the liquidity grab. Give the price some space to move, and don't keep your stop loss too tight. For your target, aim for the next key sell-side liquidity. This way, you trade with a clear plan. Now let's continue with the second trading setup. In this setup, we use 2 time frames to enter the trade. The 1-hour chart as our higher time frame and the 5-minute chart as our lower time frame. On the 1-hour chart, we analyze the market structure to find the trend. Look for breaks of structure and changes in character to find the direction. Then we mark the fair value gaps, which serve as our optimal trading zones. Then, we wait for the price to pull back inside the FVG area and then switch to the lower time frame. On the 5-minute chart, all we need is an entry reason to set up the trade. a liquidity grab formation inside the higher time frame FVG. Once we see that, we enter the trade and set our targets. This strategy works because it combines three important concepts. It helps us trade with the trend, take entries from optimal trading zones, and use lower time frame charts for extra confirmation. Now let me show you how it works on the price chart. In the first step, we identify the market direction by marking breakouts and reversal signals. We're going to use the Price Action Toolkit indicator to identify the trend. So let's go to the Settings tab and enable BOS Chalk and Chalk Plus in the Market Structure section. Here we can see that the price is breaking structures to the upside on the 1-hour chart. So, we are witnessing an uptrend and only looking for buying opportunities. Next up, we have fair value gaps. If you enable this option in the indicator settings, they will automatically appear on the chart. Fair value gaps represent imbalances on the price chart where there's a gap between the fair value of price. The market often returns to fill these gaps as price seeks balance. We'll use these gaps as key areas of interest, expecting possible price reactions. First, we wait for the price to return inside the gap, and then we look for confirmation signals on the lower time frames to enter a buy trade. So, let's switch to the 5-minute chart. Here, in the final step on the lower time frame, you want to look for signs of a possible reversal. One strong signal is formation of a bullish liquidity grab pattern. This indicates that sellers failed to push price lower, signaling bullish momentum. If the following move also forms a change of character, it provides additional confirmation. Now let's open the trade. You can place your stop loss below the low of the liquidity grab, and your target can be the next important level on the higher time frame. Similarly, in a bearish setup, start on the higher time frame by identifying the trend. In this case, the market is making lower lows and lower highs. So, it's in a downtrend, and we are only interested in selling opportunities. Now, let's mark the fair value gaps as potential supply zones. When the price pulls back into one of those gaps, switch to the lower time frame and look for a bearish liquidity grab above a recent high. Enter the trade after confirmation. Place your stop loss above the liquidity grab and aim for the next key level below. With all that said, make sure to use proper risk management to protect your capital. Stick to your plan and avoid emotional decisions. Wait for high-quality trades to form, and never risk more than 2 to 3% of your account per trade. Now let's continue with the final trading strategy. The third trading strategy also uses 2 time frames and combines the concepts of buy-side and sell-side liquidity, liquidity sweep, and fair value gaps as an entry point. So what is buy-side and sell-side liquidity? Liquidity above a high or a group of highs represents buy-side liquidity, and liquidity below a low or a group of lows represents sell-side liquidity. Now what happens around these levels? Institutional traders or smart money often target these liquidity zones. For example, if smart money wants to buy an asset, they need a lot of sellers in the market to fill their large buy orders. So, where are the sellers in the market? We know that if the price taps into a key support level, many retail traders or even institutions will go long. They will place their stop losses, which are basically sell orders, somewhere below that area. Smart money will push the price lower to grab that sell-side liquidity and activate those stop losses. This gives them enough selling pressure to fill their large buy orders. Also, breaking below this level will cause some sellers to jump into the market, thinking the price is about to drop further. But in many cases, after smart money grabs the liquidity, the price quickly reverses and moves higher. This traps both early buyers and breakout sellers. The same logic works in reverse for buy-side liquidity. If smart money wants to sell, they need buyers. So they push the price up above a key resistance level, trigger buy stop orders and breakout entries, and then reverse the price downward after collecting enough liquidity. With all that being said, some liquidity levels are more important than others. Certain criteria can help you spot the stronger ones. For example, liquidity around major swing highs and lows, higher time frame levels, or areas with multiple equal highs or lows tend to be more significant. Now let me show you how the third trading strategy works on the chart. First, mark the buy-side and sell-side liquidity zones on the chart. Then, Wait for the price to break out beyond one of these zones, and then quickly close back inside the range. This shows a liquidity sweep, or false breakout, where smart money has collected the orders and is likely preparing to move the price in the opposite direction. Then, zoom into the lower time frame and look for fair value gaps that formed right after the sweep. These gaps show imbalance and can act as entry zones. If it's a bearish scenario, for example, after a sweep above a buy-side liquidity level, look for a gap and signs of a reversal. Once confirmed, you can open a short trade. Place your stop loss above the high of the sweep and target the next key level or sell-side liquidity below. Same concept applies to the bearish scenario. We focus on the sell-side liquidity below key lows. When the price sweeps this level and closes back inside the range, it signals a bullish liquidity grab. Then we zoom into the lower time frame and wait for the indicator to highlight a bullish fair value gap that forms right after the sweep. This gap is used as the entry zone. Enter a long trade from the gap, place your stop loss below the swing low, and target the next buy-side liquidity level. This simple process helps you trade with smart money, not against it. Remember, more trades does not mean more profit. Waiting for high-probability setups to appear and filtering out low-quality ones is a skill that takes time and discipline to develop.